everyone. Welcome to another episode on tax series. The next episode we shall be looking at is changing accounting date rules under basis period. So previously we've looked at commencement rule, we have looked at the cessation rule, and quickly we shall be looking at the change in accounting date rules. During our class on commencement rule and changes and cessation rule, we had mentioned that both rules were impacted by the Finance Act 2019. So there was a new treatment. So we have a new rule for accounting for commencement and cessation, depending on when the business either commences or ceases operation. But for change in accounting date rules, uh, this is not impacted by Finance Act. So the same rule that we have or that we know is what we will continue to use. So changes in accounting date rules is basically used or it's applicable in scenarios where a company has changed its accounting date or a company is about to change its accounting date and wants to determine the most tax efficient date to use. Okay, so for example, a company could be using 31st of December as its financial year end before. So we have 31st December to prepare his financial statements. And all of a sudden, maybe because of changes in management structure or because of an acquisition by another entity, the company wants to change to 31st of March to prepare its financial statements. So when a scenario like this occurs, we will say the company has changed its accounting date and there is a tax implication for changes in accounting dates. Okay, so it's quite easy and straightforward. When a company changes their accounting date, there are certain rules that we need to follow in determining the tax implication. Okay, and I've highlighted the rules down here. These are basically 7 steps to follow. Step one is that you need to identify the old accounting dates. For example, in my this example I have here, the old accounting date is 31st December, and the company has decided to use 31st of March now. So the step two says identify the new accounting date. So 31st of March going forward is going to be the new accounting date. So the next step would then be to identify the year of change. Identify the year of change, which is a very, very critical aspect of this step, because where the year of change is wrongly identified, it is going to affect every other calculation that you are going to be doing. As we go down, we are going to see how to identify the year of change. But briefly, the year of change is the year the company has failed to use the old accounting dates. The year a company has failed to use the old accounting date. If, for example, we have 31st December 2001, I have 31st December 2002. Let me have one more. 31st December 2003. Then all of a sudden now I have 31st March 2004, 31st March 2005, 31st March 2006. So what you would notice is that the company was using 31st December to prepare its financial statements, and all of a sudden it has changed to 31st of March. So when is the year of change in this case? Okay. So if you look at let's focus on these years that we have. The question I would like you to ask is that in 2001, was the old accounting date used? If the answer is yes, then that is not your year of change. Okay, so in 2001, old accounting date was used, so that is not your year of change. In 2002, old accounting date was also used, right? That is not your year of change. In 2003, the old accounting date was also used. That is not the year of change. But in 2004, even though the period between 31st December 2003 and 31st of March is just 3 months, the question is that, do we have the financial statement prepared as at 31st December 2004? If the answer is no, then our year of change is going to be 2004, right? So the year the company has failed to continue using the old accounting date. So our year of change is 2004. So once you identify the year of change, the next step is that you need to identify two other subsequent years after the year of change. So in this our scenario, the two other subsequent years are going to be 2005 and 2006. Okay, so these 3 years will form our relevant years of assessment under the change in accounting dates. So the three relevant years in this scenario are going to be 2004, 2005, and 2006. So step 5 now says prepare the basis period and compute the adjusted profit on a preceding year basis using the old accounting date for the 3 years identified above. Okay, then step 6 says do the same thing, but in this case using the new accounting date for the 3 years identified above. Then make your decision by choosing the one with the highest adjusted profits between step 5 and step 6. So it's quite straightforward. And let's look at example 1. Okay, Palazzo Limited gave you the following information in relation to its accounts. The financial statement has been prepared using 31st of December each year. So we have 31st of June, that is 30th of 6. So using 30th oh 06 each year. So we have 30th oh 06 2010, 400,000, 30th oh 06 2011, there was a profit of 520,000. Remember that year ended means a period after 12 months, or a period all inclusive that give you a 12-month period. So year ended 30th of June 2011, 520,000. Year ended 30th of June 2012, 600,000. Then period ended September 30th September 2013, 470,000. It appears the company has now changed its accounting date between these two. Then year ended September 2014, 820,000. Year ended September 2015, 960,000. Okay, the company has now decided to be using September. All right, required compute accessible profits for the relevant years of assessment. Okay, so the steps to identify is that we need to start with the old accounting dates. Remember what we analyzed at the beginning. So let's have it somewhere here. Let's have solution. Let's have it solution to our question. Quickly, we need to have what is the old accounting date? What's the old accounting date? Okay, let's have it as it's going to be 30th of June. All right, 30th of June. Okay, what is the new accounting date? the new accounting date is going to be 30th September. All right. So once you've identified these two, you've started. The next is that what is our year of change? How you see year of change, which is very important. So let's go back to the question. As at 2010, the old accounting date was used. So 2010 is not the year of change. As at 2011, the old accounting date was used. So 2011 is not the year of change. As at 2012, the old accounting date was used. So 2012 is not the year of change. As of 2013, was the old accounting date used? No. So 2013 becomes our year of change. 2013 becomes our year of change. So I'm going to have 2013. Okay. So these are the three preliminaries that we need to first identify, such that once we identify it, we can quickly prepare the account. So we've done step 1 to 3. The next is identify two other subsequent years, which is going to be 2014 and 2015. All right. Then prepare the business period using the old accounting date and the new accounting date. All right. So permit me to bring this to this point. Okay. So we can have enough space. Okay. So we shall be using the old accounting date and the new accounting date to prepare the financial statement or to determine the tax implication. Okay, all right. So using the old accounting dates, our steps. So we'll have year of assessments, you'll have business period, and then you would have adjusted profits. Okay, these are basically the three headings you need. All right. Okay, so using that, we would have um, our year of change. You're going to start with a year of change, which is going to be 2013. Recall that we said using two other subsequent years, 2014 and 2015. So this period, using the old accounting date is 30th of June. So on a preceding year basis, remember, let me start with what we said we should always do the trick. Is that that's going to be 30th, is going to end with 30th June. So if this is 2013, this is going to be 2012. Then taking it 12 months back, this must have started from 01, 07, 2011. Okay, 01, 07, 2011. So in this case, you have the basis period on a preceding year basis. Okay, the next is going to be 01, 07, where this one stop. This one will start 2012 to 30th of June 2013. Okay, then the other one will then be 01, 07, 2013 to 36, 2014. Perfect. So you have the basis period as we have it now. So let's solve for the adjusted profits. Let's solve for the adjusted profits. Okay, the adjusted profit for 2013 year of assessment will be to look for the basis period or the period in the question that have this dates, or where we can find this particular dates in our uh, question that we have here. So we have 0107 2011 ending 30th June 2012, that is year ended. From this date to this date is going to be a 12 months period, and it's exactly the same thing with this date. Year ended 30th June 2012, which is a 12 months period. Okay, so what that means is that the adjusted profit is going to be 600,000. All right. Now, the next one is I'm looking for these dates: 0107 2012 to 30th June 2013. And if this one ends, if this 600,000 ends in June 2012, it means that this 470,000 would have started from July 2012. Okay, then July 2012 to September 2013, if you count it, 1 to 3 is a 15 months period, would give you a 15-month period. What that means is that this entire date, right, June 2012 to July 2012 to June 2013, can be found in these entire dates, in this 470,000. This 470,000 is for 15 months, right? That is from June 2012 to September 2013. While what I'm looking for is a 12-month period. So I have a 12-month period inside a 15-month period, and assuming the profits were earned evenly. So my answer is going to be is equal to 12 over 15 multiplied by the 470,000. So I have extracted it out. I have 376,000. Good. So the next dates will be, I'm looking for July 2013 to June 2014. Now, because for this second date, I have 12 months period in this 15 months period. Okay, it means that there's an extra 3 months. So if this one ends in June 2012, that means still included in this date is July, August, September. So the 3 months of this last date is also included in this 470,000, while the remaining 9 months is included in these 820,000. If you do your maths very well, you would see what I'm talking about. So to solve the adjusted profit for that, you would say my 3 months that can be found in the 470,000 is going to be 3 over 15 times 470,000 times 470,000. Okay, let's put it in brackets. Then plus, I've agreed that the second 9 months, 9 over 12 times 960,000 times 820,000. Okay, the remaining 9 months can be found in this 820,000 that represents a 9 months period. 820,000 for a 12 months period. So I'm looking for the 9 months in this 820. So times 820,000. Okay, and that gives us 709,000. That's all. You're done. Um, so let's add up together. We have 1,685,000. All right. So quickly, let's move on to that's it. Let's move on to the just copy and paste. Let's move on to the new accounting dates. Let's have it side by side. Okay, the new accounting dates. Now, for the new accounting date, let me just change this to using the new accounting date. Is also the same step. Now, the new accounting date is now September. So I'll change this to September, right? Ending 2012, but must have started from October. Okay, so the figure started from October 2011 and ends in September, being the new accounting date. Then the next one is also going to be ending in September 2013, but must have started in October 2012. So we also have September 2014, but must have started in October 2013. Right, so you have the new accounting date. Okay, so the next step is to now determine the adjusted profits. So where can we find these dates in our analysis here? Okay, so I'm looking for a period between October 2011 to September 2012. Okay, so October 2011 to September 2012. So what that means is that it's possible that I can see the dates somewhere here and here. Now, why you wouldn't even consider 520,000 is that it ended in June 2011. But what I'm looking for started from October 2011. So if this one ended in June 2011, means that this one must have started July 2011, August 2011, September 2011, then October 2011. So what that means is that um, the first 9 months of this business period can be found inside this 600,000. The first 9 months, okay? Included in this 600,000, if you analyze it carefully, this one starts from July, right? Let me write it somewhere here. It started from July 2011 and ends in June 2012. Okay, so what that means is that my October that I'm looking for is found here, but where this one extends to September, this one ends in June. So I have October to June. So October to June is going to be a 9 month period. So I can find a 9 month period in a 12 month 600,000. So, and that means that the remaining 3 months that I'll be looking for, which are July 2012, August 2012, and September 2012, will be found in this 470,000 that represents a 15-month period. So, going by that, my calculation is going to be, let's have it here. It's going to be it's equal to 9 over 12 multiplied by 600,000 plus 3 over the 15 months multiplied by 470,000. Okay, and that will give us 544,000. Okay, then the next thing is this dates. Where can I find it? So if you look at this one, it ended on September 2013, which is exactly where this one ends, September 2013. And if you recall, from October 2012 can be found here. This is a 15-month period, okay? Then the entire 12 months here can be found in this 15-month period account. And that's going to be is equal to 12 over 15 multiplied by 470,000. That will give you 376,000. Then is equal to uh that will be this guy. If you look at this date here, it's exactly the same date with this one. Year ended September 2014. Year ended September 2014. So because it's the same thing, I will just say is equal to 820,000. That's 1,740,000. So that's it. You have computed the adjusted profits using the old accounting date and the new accounting date for the three relevant years. These are the relevant years for changing accounting date. So the next step is make your decision. So your conclusion is going to be that um, the taxpayer, the tax authority would assess the taxpayer using the new accounting date. Using the new accounting date. Okay, because it gives a higher tax liability, a higher tax profit, adjusted profit. You know, the higher the adjusted profit, the higher the taxes that will be paid. So the taxpayer will be assessed to tax using the new accounting date. So, ladies and gentlemen, that is how to account for change in accounting date. Simple. Let me do a quick example for this question too. I won't solve it. I'll just show us the year of change. So once you can get the year of change, then you can get any other thing. So for example, Chill Limited has been in business for several years. The adjusted profits of the company for the following years are as follows. So you see the year ended is that the company has been using March to prepare its financial statements. Then all of a sudden the company changed to December. If you analyze it very well. So in analysis, just say what's the old accounting date? Old accounting date is what is going to be 31st March. 31st March. Okay. Then what's the new accounting date? The new accounting date obviously is now 31st December. All right. Then what is now the year of change? The year of change is now, look at that. In 2004, was the old accounting date used? Yes. So 2004 is not the year of change. 2005, was it used? Yes. 2006, even though the company changed in 2006, the old accounting date had already been used before they prepared another financial statement. So 2006 is not the year of change. Okay. 2007 was the old accounting date used. Do we have 31st March 2007? The answer is no. Therefore, the year of change is 2007. All right. Then two other subsequent years will then be 2008 and what? 2009. All right. So that's where I'm going to stop for this. Look at this question carefully. And based on what we've done here, prepare your adjusted profit and basis period using the old accounting dates and new accounting dates. And let's have your conclusion. You can tell me your results in the comment section. I will respond to you. So, ladies and gentlemen, thanks for listening. We have come to the end of basis period. We have now looked at commencement, cessation, and change in accounting dates rule. In our next class, I will be introducing you to another strong topic, which is how to compute capital allowance. Once you are able to identify basis period and compute capital allowance, every other topic in class be as easy as anything. Thank you for listening and look out for my next class. Please don't forget to subscribe to my page and click on the notification box. Thank you and bye.